Hey everybody, welcome into Mining Stock Daily. A little bit of a new situation, but we have two long-form episodes for you this week, and we're going to air that first one. Happy to welcome in Rick Rule. Everybody knows who Rick is, but this is a long conversation, and we kind of dive into the macro a little bit with Rick, with the things that outside of the resource space, what are the things he's watching when he starts to pick stocks. And so we try to take a couple different angles with Mr. Rule and things he maybe hasn't chatted about much in other appearances throughout his interviews. So I think we do that. It's an hour-long conversation. There's a lot to it. Special thank you to Fireweed Metals, Victoria Gold, Visa Silver, and Arizona Sonoran Copper for your continued support of Mining Stock Daily. And so let's just jump into it. Here's Rick Rule and myself talking all things resource stocks and Canadian exploration equities. I'm really happy to welcome in Rick Rule. He needs no introduction for anybody listening in to Mining Stock Daily. He's a very popular guest, not only this podcast, but all the natural resource investment content shows out there. But I guess my turn this time. Rick, welcome back to Mining Stock Daily.
Thank you, Trevor. It's a pleasure to be on with you.
Yes. Listen, I as I mentioned to you before, you're in high demand for these interviews lately. And so I want to try to find different angles a little bit and maybe chat with you about some things that, some deep dives into some maybe niche parts of resource investing. And I want to ask you a little bit and start out about this newfound, bull market we found ourselves in over the last few months. Obviously, precious metals are having a nice rise. We saw copper move above $5 per pound, and that's had a pretty steep correction in itself. But you were really pounding the tables on gold equities in the later, half to the later stages of 2023, expecting in such a move. And so I kind of want to go back in time and kind of pick your brain a little bit on how you were allocating your capital in junior resources in 2023. What were you seeing, and then how were you strategically deploying that capital?
Well, it was pretty obvious to me in 2023 that the stage was being set for gold in particular to do very well. But the market was paying no attention, and the market was paying even less attention to gold stocks. And that, to the extent that gold was in somebody's mind, it was concentrated in very few issues. When I started to see the gold moving up and the gold stocks not moving up, it was very clear to me the reason. The gold was moving up not because of individual investor buying, but central bank buying. And central banks don't buy stocks. So the dichotomy between the move in the gold and the move and the lack of movement in the gold stocks was just completely clear to me. And I thought that more likely than not, there aren't many certainties in the world, but more likely than not, that as the gold narrative gained acceptance with individuals, with central bank buying, that individuals were more inclined to buy both gold and the gold shares, and that the gold shares would become likely beneficiaries. And in this circumstance, at least within a small universe of gold stocks, I was correct. You will hear from the gold mining industry itself that the gold mining shares haven't moved. That's incorrect. The highest quality gold companies in the XAU, companies like Agnico Eagle, Wheaton Precious, have done very well. The length and breadth of the gold equities haven't done well because investors are still concerned as businesses that they aren't, as a whole, well-run businesses. So in my holdings in the senior gold equities, I have tended to favor companies that have very strong operating margins and have long track records around intelligent capital deployment. I remember well the decade, Trevor, 2000 to 2010, when the gold price went from $250 an ounce to almost $1,900 an ounce. And the free cash flow per share of the XAU declined. It took real skill to screw up a 7-fold increase in the selling price of your commodity, but the gold mining industry did it. So I'm very selective. I don't buy the sector. I try to buy companies that I believe will outperform. Pardon me. In the juniors too, I looked at the beginning of 2023, a junior mining sector that had about 3,000 companies worldwide. And I noted and have noted for years that probably only 10% of those are viable and probably only 5% are attractive. And so I tried to allocate to companies that I thought were A, selling at a discount to what they were worth, and B, were of a scope and scale that when the sector returned to the radar of institutional investors, that they would be bought. That, in a very broad sense, is how I allocated. And that worked very well with one exception. I was a large shareholder and am a large shareholder of Franco-Nevada. About 14% of Franco-Nevada's net asset value was accounted for by their shareholdings in Cerro Colorado, the mine in Panama, which was nationalized. Investors in the very near term are not good at arithmetic. And the temporary, at least, removal of Cerro Colorado from Franco-Nevada, 14% of net asset value, caused their share price to decline by 42%. An irrational response, which led me, ironically, to increasing my position in Franco-Nevada. But I'm just pointing out Franco simply to say that most of my allocation in the big gold stocks was extremely constrained to companies with great operating margins and great long-term capital allocation decisions. I was less a buyer of market beta then than a buyer of alpha. In the smaller stocks, I was looking very much to deposits like Reunion, as an example, that had the ability to become tier 1 deposits and likely would need to be consolidated, or if not, at least would migrate from being owned by retail holders to being increasingly owned by institutional holders. And that worked well for me.
With the gold producers, was there a sustaining cost or a cash cost per ounce that was kind of like, don't cross that line or else you're off my books, I'm not interested? I mean, you can say there's a handful of companies out there that continue to produce at, $1,100 per ounce, but the Newmonts and the Barracks are much higher than that. So but is there a line in the sand for you?
I think you need to look at AISC, and my preference is to be at the bottom quartile for all-in sustaining costs. But if I see something in a company's pipeline that is likely to either raise or lower the AISC on a going forward basis, or even more troubling, if I look at production declines, impending production declines without a development pipeline, investing is not a rear-looking business, it's a forward-looking business. The best indication of forward success is past success, of course. I would say, as a rule of thumb, I want existing and prospective all-in sustaining capital to be in the bottom quartile of the gold mining industry worldwide, which is to suggest below $1,100 per ounce. I want to, where possible, to have the company have a 10-year track record where their return on capital employed is in the best quartile of the industry. This is only relevant if the management team that generated that performance is still in place. But where possible, I like both of those things to coalesce. It is true that I own Barrick. Barrick trades at a substantial discount to Newmont. Newmont, I would suggest, has historically been troubled by having too many Tier 2 mines, which is to say they have too many mines. Their recently announced strategy after their acquisition of Newcrest has been to rationalize their portfolio, keep the big mines, monetize the small mines, and bring down the debt. If they do that, I'll likely be a Newmont shareholder. I have sold some Newmont puts, looking to acquire Newmont more cheaply. I favored Barrick because of their tendency to large mines, and because their market capitalization has been depressed as a consequence, of a lot of their free cash flow coming from Africa, which people are afraid of. They also sold off on the acquisition of Reko Diq, the new copper gold deposit in Pakistan. This is a deposit I've known about for 20 years, and while I'm justifiably concerned, I think, about building a mine in Baluchistan, I'm also attracted to the fact that this mine, if they successfully operate it, will make a meaningful contribution to the company. So I guess what I'm saying is that there's a variety of circumstances that go into stock selection, and it varies stock by stock by stock.
Yeah. All right. Well, let's talk forward looking. We are in the last month of Q2. We've had a substantial move in the gold price. This will be the first full quarter where we're going to see gold above $2,300. I don't even know where we're trading at today as we record Wednesday. We didn't have this. This started kind of halfway through Q1, give or take. And we've been speculating here on this podcast, Rick, about really anticipating those Q2 financials for the producers, anywhere from the big tier producers to the mid tier producers. Do you feel, as I do, and I would love to hear some constructive feedback on this, that it could potentially be a massive catalyst for institutions to sit back and watch these financials come in and be like, holy cow, how did we miss this?
I don't think one quarter is going to be enough. And I also think that in amongst the good news, there's going to be some bad news. We've seen, as you suggest, decent increases in the gold price. We've also seen continued increases in operating cost. If you look back over 3 years, energy prices, as an example, have doubled. Steel prices have increased. Cement prices have increased. Labor costs, skilled labor costs, are increasing at about 20% per annum. In particular, the social costs around producing gold are currently increasing at about 25% per annum compounded. Taxes, royalty, non-tax payments by mining companies to communities. So I think what you're seeing is that the investment community is looking for margin increases that may be less than they suspect as a consequence of cost creep. What I think you're going to see is a continued bifurcation in the gold space between companies that have large assets where they can focus on driving down costs, where they can lavish love and attention on a smaller number of high-quality deposits, rather than having their attention diverted over a large number of deposits. If you look, as an example, at the 5-year outperformance of Agnico Eagle relative to the rest of the majors, that's been driven both by fortuitous acquisitions, which is to say buying assets when nobody else wanted them, high-quality assets, but also a relentless focus on high-quality assets and driving down operating expense. What happens in the case of Agnico Eagle relative to most of its large-cap peers is that increases in the gold price generate really meaningful margin increases because they've been less hampered by cost creep. Now, the other side of that, Trevor, is, and this is ironic, rapid increases in the gold price help the margins of inefficient companies more than they help the margins of efficient companies. If you're a $2,200 producer and the gold price goes from $2,300 to $2,400, you've doubled your margin. If you're a $2,000 producer, you've only increased your margin by 25%. So, I understand the leverage inherent in marginality. For myself, I'm an old guy. If you take away a bunch of my downside with a quality asset, I'm okay if you take away some of my upside due to marginal returns.
Mm-hmm. You know a lot of people. You have a lot of discussions. Are the institutions, I guess the quote unquote smart money, are they paying any attention to this space yet? And we've got Nasdaq
Yeah,
at a
we're
new
starting.
all-time high today. Are they still
I
chasing
mean,
tech?
uh, understand that we're coming off a very low base.
True.
Precious metals and precious metals related assets enjoy, if that's the right phrase, a 0.5% market share among all savings and investment asset classes in the United States, which is to say, to the institutional investors, we're as relevant as a pimple on an elephant's behind. We are seeing an increasing level of interest from an extraordinarily low base. Over the last 4 decades, that market share of precious metals and precious metals related assets to total assets has averaged 2%. It's all the way down to 0.5% now. Part of my investment thesis is that I think that gold's market share or precious metals market share will return to mean. I'm not suggesting it's going to win the war against the U.S. Treasuries or win the war against the tech stocks. I'm just suggesting it's going to lose less badly. If the mean market share of precious metals and precious metals related assets in just U.S. markets returns to mean, demand increases fourfold. And that's what I think happens. Will we ever be centerfold at the Fidelity Investors Investment Conference? Probably not. If we do, that's a wonderful sell sign. But will demand increase? I think in terms of perception, you need to go back one step. You need to look at the dichotomy that you mentioned at the beginning of this interview between the bullion price escalation and the equity markets. And that's entirely explained by the fact that until 9 weeks ago, the bullion buyers were all central banks. Retail participation, as measured by holding or disholding bullion-oriented ETFs, showed that retail investors had been for 2 years sellers, not buyers of gold. The strength in the gold market was, until 9 weeks ago, all central banks. And the central banks weren't buyers of gold shares, just gold.
So are the retail buyers coming back in the last 9 weeks? Is that what you're suggesting?
Yes, the last 9 weeks there has been fairly strong. And I should segregate. There was retail buying of precious metals in China, in Taiwan, and in India. So when I say retail holders, I misspoke. I meant retail holders in Europe and North America. The last 9 weeks, there has been fairly strong additions in the various ETF holdings. And anecdotally, there has been fairly strong retail physical demand among the biggest and the best bullion dealers in at least U.S. markets.
Okay. All right. Very interesting. I do want to ask you a little bit about the macro and pick your brain a little bit about, you could get lost in macro. And just as a gold investor, you can nitpick every little thing. It's like finding a needle in a haystack, a macro haystack of trying to make decisions of why gold is doing what it's doing at any time, whatever market you're in. But the macro is incredibly volatile and interesting right now. As we're speaking today, as I mentioned, we've got the big boards in the U.S., new all-time highs. We've got Treasury yields falling, so they're getting a bid. You've got gold and silver precious metals finding some sort of base, I would say, and getting a little bit of bid as well. But the big move I think we saw this week was the manufacturing data that shows things are slowing down. We are just less productive. And oil and copper just really took it on the chin the last couple of days. And so I'm just kind of curious, when you come sit at your desk every day and you're maybe looking to see if you want to buy a stock, I mean, how much of the macro do you pay attention to? And what's the most important items that's, on your forefront?
Macro is important to me in a 5-year term. It's not important to me as a speculator. Micro is important to me as a speculator. Factors at the firm level or factors at the commodity level are important to me. in a 1-year time frame. When I look at gold in the 5-year time frame, what really matters to me is macro. It's the fact that investors believe that inflation is explained away by the CPI. In other words, investors are expecting 2.7 or 2.6 or 2.7% deterioration in the value of their purchasing power over time. I believe the correct number is more like 7.5 or 8. The CPI doesn't include, as an example, tax, the most important household expenditure of most Americans and Canadians. If you believe, in a macro sense, as I do, that the basket of goods and services that you actually consume is increasing by 7.5 or 8%, and you juxtapose that with the Treasury yield at 4.3%, you come away with the sense that the value of your savings in fiat-denominated instruments is depriving you of 3 or 3.2% of your wealth every year for the next 10 years. And if you think about the ramification of that, it means that there should be, over time, a dishoarding, a selling of treasuries in favor of gold. Now, if you juxtapose that against the fact that, as we stated earlier, the market share of precious metals is at a multi-decade low, and if it were to return to mean, there would be a 4-fold increase in demand. That's the type of macro that I follow. And I don't follow it with the point of view of a 2-month trade or a 3-month trade or a 1-year trade. I follow it for the point of view of a 5-year trade. Macro in the uranium market was very important to me in 2022, and I say this for instructive purposes. When materials that are necessary for the material well-being of mankind are selling at a discount to the total cost of producing them, either the price of the material goes higher or that material becomes unavailable to humankind. That's the kind of macro I love. Look back to 2022. Uranium was selling for $20 a pound. It was responsible for about 15% of the baseload electrical generation in the world. And it was most of the baseload generation around non-carbon generating. Now, it cost the industry, fully loaded, including cost of capital and tax, about $60 a pound to make uranium. So the industry was making the stuff for 60 and they were selling it for 20, losing $40 a pound and being dumb miners trying to make it up on volume. That kind of macro appeals to me. If the price of uranium didn't go up to cover the cost of production, the lights would go out. And I had to decide which I thought was more probable. So in that sense, I'm a macro-oriented investor. I'm a macro-oriented investor in the 5 to 7 year time frame.
All right, so I'm gonna put you in the hot seat. Are you a higher for longer guy? Do you buy that narrative? Did we go high
for
enough,
uranium?
Rick? No, excuse me, for interest rates.
I think this price is. I'm sorry, you're talking about uranium or something else?
I'm sorry, I'm talking about interest rates. Because you mentioned the 4.5%, and it's just an interesting conversation because you mentioned that people would exchange treasuries for gold, and that means yields running higher, and we saw what happened to gold when yields were running higher. So what would cause that divergence, that relationship to change with yields running higher with gold?
Well, it's interesting you say that. I'm old enough that I remember the decade of the 70s when yields increased by 500% and gold increased 30-fold. Some of it has to do with the reason for the increases in yields. We are obviously living in a time where equity valuations relative to the cash-generating capabilities of the companies that make up the S&P 500 or the QQQ, we obviously live in times where there's not a lot of fear. Otherwise, you wouldn't have equity valuations at these levels. There's an anticipation that things will get better and better and better, an expectation born of a bull market from 1982 to at least 2022. We operate in a world, too, where, as a consequence of 40 years of very benign times, people believe that even an event like 2008 is a buying opportunity rather than a systemic risk, which probably over the long term is true. What I think people don't get that scares me is that I think that people really, really, really are misinterpreting the impact of inflation. And people are misinterpreting the long-term implications of, in particular, U.S. government on-balance sheet and off-balance sheet liabilities relative to our budget. I believe that the only way that we service our on-balance sheet and our entitlement obligations is the way we did it in the 70s, which is to say we debase the currency that those benefits are going to be paid in. Mm-hmm. And I don't think that the market, by the way, I hope I'm wrong, Trevor. I'm not one of these guys who wants to copy the Agora copywriters. The world is going to end on Thursday, and here's how you can profit. That's not of any particular interest to me. I'm very concerned about $34 trillion in on-balance sheet liabilities. I'm much more concerned about $100 trillion in off-balance sheet liabilities. Medicare, Medicaid, Social Security, federal government pensions, stuff like that. I'm concerned about America's ability to service those obligations with an unfunded deficit that increases by $1 trillion every 100 days. They're able to do that right now because we have been in a credit bull market and an equities bull market for 40 years. And people have learned not to be afraid. People look at the equity indexes breaking out to new highs, and people actually believe that in the long term, the Fed controls the bond market. I'm very nervous that the market will reassert control over the bond market. What would happen if, like in the Clinton era, they gave a treasury auction and no one came, and they had to buy the issue by printing new money? Mm-hmm. What would that do to faith in the bond market? And what would that do to interest rates? I would love to be able to buy U.S. 10-year treasuries at 71 years of age. I would love to believe that I got a competitive rate of return on my savings, and that all I needed to do was clip coupons. I'm old, fat, bald, rich. I'd love that circumstance. But the way I do the arithmetic, they're going to pay me 4.3 in a currency where the purchasing power is declining by 7.5 or 8. Traditionally, credit markets have required a 2% real yield on riskless paper. If you follow my arithmetic, which suggests that the purchasing power of the dollar is declining at 7.5% compounded, that would imply a 9.5% rate on the U.S. 10-year Treasury. Of course, the 30-year Treasury and the 30-year fixed mortgage and the prime interest rates are all derivatives of the 10-year rate. My nervousness is that with the fiscal state of the United States, the fiscal state of the creditor, that interest rates are substantially understated as a consequence of 40 years of experience, and hence private credit market behavior that I am currently concerned is irrational.
It's not just the United States, though. I mean, obviously we are, biased because, but it's every major sovereign country in the world right now. Italy, China, so, I mean, they're all over the board. The debt behold in the U.S. is mighty high, but it is, it looks almost manageable to see it on a chart against the likes of China. But, this could be a global phenomenon, right?
I mention the United States simply because it has 23% of the private savings and investment assets of the world. Yeah. And I also mention it because as an American, I have the statistics in my hand to argue it. China is, first of all, opaque. And second of all, I'm embarrassed to say that at my age, keeping track of U.S. statistics is challenging enough. I don't need to go to China to make my point. Your point, however, which is to say that, as an example, Europe's balance sheet and income statement is substantially worse than the American balance sheet and income statement. And with China, the nature of private credit in China is such that we don't know what their balance sheet and income statement is. So when I express concern about this in the United States, I'm not meaning to single the United States out. I'm only an informed observer in the United States, where I'm less so in other jurisdictions.
Yeah. And that leads to somewhat of a bigger question about how to, or even if this debt load in the United States is even manageable, Rick. I mean, it's gotten so out of control. I mean, the idea of even inflating it away is politically unpopular. The productivity we've seen declining. Birth rates have declined, so therefore productivity is harder to manage and increase. With a lot of people are banking on this AI increase in productivity, so that's obviously yet to be seen. A lot of hype. It's just, I think a lot of the hands are tied behind their back, and it just kind of seems like this has gone on far too long and added way too much, that the only solution that any administration has, any 4 years, is to just solve it with more debt, more short-term solutions, and forget about what happens 10, 15 years from now. I mean, have people just kind of thrown in the towel?
In 1980, Americans demanded change. They didn't actually get it, by the way. Reagan didn't cut the size of government. He just slowed the growth of government. But he did allow a market in interest rates. And that was ugly. Many people don't remember the 81, 82, 83 recession. But they did break the back of inflationary expectation. I suspect that the route out of our current dilemma will need to involve three things, perhaps four. It will need to involve some more economic deregulation so that the private sector in the United States can generate more wealth. We still have a society, as exemplified by the tech stocks, where 6 young kids can commandeer a garage in Sunnyvale, California, and out pops Google or out pops Apple. If you look at the United States, our collective initiative and persistence has generated so much private wealth that we've been able to finance public stupidity. And I suspect across all odds that that's going to be true going forward. But we also need to address collective stupidity. First of all, it's going to be very unpopular, but we need to means test entitlements. The idea that somebody like me, yes, I paid into Social Security all this time, but the money's gone. It's already been stolen. We need to means test Social Security. We need to means test Medicare. We need to means test Medicaid. With Social Security, when it was instituted, it began at age 65, and the average life expectancy of an American male was 66 years. So it was geared to provide poverty-level remuneration for the last 1 year of the average worker's life. The average American male now lives 84 years, and you could begin collecting Social Security at 62. So there's going to have to be a change in duration, which is going to be hugely unpopular. When I talk about Social Security, I get all kinds of emails from all kinds of folks my age who said, I paid into it. I deserve my benefits. They don't understand that the money's been stolen. It's as though you had your IRA and you populated your IRA with IOUs from yourself that you borrowed and used for current living expenses. It's important that we restructure entitlements. It's important that we restructure the current account. And this is going to be very, very, very difficult politically. People that receive subsidies from government regard those programs as useful and justified. People who pay for them regard them as fraudulent and wasteful. We need to deal with all of it. But ultimately, the way that we're going to deal with it is the same way that we dealt with it in the decade of the 1970s. We came into the 1970s having fought the war in Vietnam, which of course we lost, and the war on poverty, which of course we lost. What we had left over was unsustainable debt. And we dealt with that by devaluing the purchasing power of the US dollar over the 10 years of that decade by over 80%, which is precisely what we're going to do this time. We don't have a second choice. At a constant dollar, aggregate net federal debt at $130 trillion with an on-balance sheet budget deficit of $3 trillion a year is not sustainable. This isn't narrative, Trevor, okay? I'm not saying Social Security is bad. It's not sustainable. And the only way politically that we can get out of this is to inflate away the net present value of the obligation. It's just arithmetic.
It's really interesting. You mentioned, the lifespans are expanding, and as people are obviously staying alive longer, that's requiring a lot more healthcare and more people needed to go into healthcare. But that is a service, right? And as more people are going into the healthcare industries, that means they're not going into the productivity industries. They're not producing things, right? And so that needs to take huge account.
The population's aging too. This so-called Social Security Trust Fund that we spent on 30-year treasuries was accumulated by my generation. There were a bunch of us youngsters who were supporting a much smaller, older population. Well, that's all changed. Those of us my age who voted ourselves all these cool benefits and forgot to pay for them, by the way, are passing the bill to your generation. And your generation is smaller than our generation was. So we have a smaller number of people supporting a larger number of beneficiaries. Demographically, we have turned around entitlements finance simply as a consequence of demographics. Fewer earners, more spenders.
I got to quickly turn the subject here for the last couple of minutes, Rick, and I'd feel bad if I didn't ask you about our neighbors to the north in Canada. The TSX venture is in an uptrend, if you can believe that. It's kind of crazy. Nice to see. The chart itself is still terribly ugly, but we'll take the last 9 weeks in an uptrend. That works. Thoughts on a cycle here in junior mining. It hasn't necessarily been a tide that lifts all boats, but there are winners out there, and there are still a lot of exploration companies stuck in the mud. How are you kind of approaching, this spring into the summer? And what are you watching as far as the explorers? Is there going to be a time this year where people are going to start trickling down the lifespan of a mine and looking at exploration equities?
It's interesting. I think the index itself is a disaster area because I think the junior mining space, taken in toto, is a disaster area. If you merged every public junior in the world into one company, Junior Explorco, in a very good year, that company would lose $2 billion. In an average year, it would lose 4 or 5 billion. So what is that company worth? 8 times losses? 12 times losses? 15 times losses? Which is to say, if you invest in the sector, the junior mining sector over time, the whole sector, you will go broke. What you need to understand is that 5% of the companies in that sector generate so much value, so much performance, that they add legitimacy and even luster to the sector. The people in the sector who have been accustomed to being overfinanced for 40 years complain about a lack of capital in the sector. Last 18 months, I've probably participated in 25 private placements. Very few of them at substantial discounts to market. Very few of them, including warrants, which is the chief inducement to participating in a private placement. And all but 4 have been oversubscribed. which is to say, of sort of 25 financings I've participated in, at least 20 of them have been oversubscribed enough that I got cut back in. Yet the industry says it's underfinanced. You understand the dichotomy that we have here?
Absolutely.
You have seen a circumstance in the last 12 to 18 months where the best companies in the sector are uniformly up by 30 or 40%. And their weighting in an index pulls the whole index up. They do a good thing with the index in Canada, too, which is to say when the companies get below a certain size, which is to say when entropy sets in, which is true for 80% of the issuers over time, they get deleted from the index. So the index itself is gamed in a way that it has a bullish bias. And I think that you've seen that reflected in the index. I would like to have seen the decline much deeper. I would like to have seen 500 issuers go bankrupt. I would like to have seen the general and administrative expense that goes to those 500 zombies taken out of the market so that that capital could be used, better used, by some of the remaining issuers. The fact that I would like it doesn't matter much. It doesn't happen. And I think that you're going to continue to see for the next year or year and a half decided outperformance by the best of the best. If past is prologue, the investors who see the sector do well will once again return to stories. They'll look at 5-cent stocks that ought to be priced at 0, and they'll crowd into them hoping they go to 25 or 30 cents. I think you will continue to see investors that don't pay any attention to trailing ratios in the company, like the percentage of capital raised that goes to general and administrative expense, which is, by the way, shocking, not into the ground. And they will continue to exhibit that odd investment trait of got a hunch, bet a bunch, which is to say, I'm afraid that the whole sector is going to trade up. And I'm afraid that a whole new generation of victims is going to be born as a consequence of that strength.
Serious concern. But I will say there's got to be some silver lining, and I'll share with you a personal story, Rick. Obviously I've not been investing or doing private placements as long as you have, nor have I had the success you have. But I will say for the first time since doing private placements in the last 4 years, I watched one of my equities start moving really high, and I said, wait a second, I think I have warrants. And sure enough, for the first time ever, I had warrants in the money. And I was like, I sat there to myself and I said, I don't even know what to do. This has never happened before. And so it was a whole new learning experience about how to get those warrants exercised. So there's got to be a silver lining. Like, that's the reason you do participate in those financings with those warrants.
I would suggest to you, Trevor, that the name of your service, Mining Stock Daily, suggests that you're an involved investor. I would suggest that whether or not you get it right, you attempt to create in your own mind some framework of value for the stocks that you own. I hope that once you've created that framework of value, when the stock exceeds your estimate of its value substantially, you're smart enough to sell some stock.
Well,
you are competing with a broad range of investors who seem to regard these stocks as ticker symbols. They seem to regard them as floating abstractions that have bids and asks and trends, where these floating abstractions are seemingly unconnected to the fundamentals on the companies. So I would suggest to you that your recent experience with successful warrants is likely to be continued in the next 5 years, due partly to the fact that the market got oversold, but due probably more primarily to the fact that you're learning how to do what you do.
Right.
I hope.
Yeah, and I think
you don't.
Go ahead. I didn't mean to interrupt.
I just hope you don't become. I hope you don't become hubris-ridden, which is to say, I hope you don't let your guard down as a consequence of a couple successes. I did that in my 20s. I confused a bull market with brains, and it had absolutely disastrous consequences for me. It's a mistake I no longer make.
Yeah. Well, really what I had done in the last couple months was, when things were really, really bad and completely oversold in 2023, and there were, I was looking at some of the holdings, my current holdings, and they were down really hard. And I said, this doesn't make any sense. I bought a large tranche. I kind of had to hold my nose and buy stock on the open market. And what I did when those equities finally started moving, if they doubled, I took my capital off. Like, I just wanted to take the profit. I know the volatility in this sector. I know how bad it is. So I just took the money when I could.
That's an important thing to do, particularly when you get moves in price that are uncorrelated with moves in value.
Right.
In a bull market, you buy a stock because you think something's going to happen in the company that's going to justify the value. And then the price moves without the event that you bought it for taking place, which is to say the price doubles in anticipation of the event taking place. In those circumstances, you always take your money off the table. You always take your money off the table. But periodic rebalancing, if you have bought in panics, is a good thing to do. A very, very, very good thing to do.
Right. Rick, I look forward to seeing you next month at the Rural Investment Symposium in Boca Raton. There's going to be a link in the show notes here. You've been doing it for a while, and I got it. It's my first time. It's going to be my first time. So I'm really excited about attending this thing. It's going to be awesome.
I'm excited to have you there. I believe, I've been told we've done this for 28 years now. And I can tell you, we've honestly endeavored to make it a little better every year, which means after 28 years, it's pretty good. Whether you attend live in person in Boca Raton, which would be my preference, I like live conferences the best, or at home via live stream, if you can't come to Boca Raton, understand a couple things. First of all, we're going to give you 60 hours of programming over 4 days, more than you could absorb. To that end, the whole proceeding will be recorded, including the breakout sessions. You should review the recordings a lot, because we're going to give you more than you can absorb. Yeah. The second thing that you need to understand is whether you attend live or via live stream, that every public company exhibitor there has been vetted. At most conferences, qualification to be an exhibitor is a check that cashes. In our case, we have to believe in the exhibitors enough that we own shares in them. Sadly, the fact that I own shares is no guarantee that they go up, but it is a guarantee that it's been vetted. Finally, whether you attend live or live stream, if for any reason you don't believe that we have earned the price of your admission, there's a gold-plated money-back guarantee. If you aren't satisfied with the value that you received, whether you watch it at home via live stream or whether you come down to Boca Raton to the conference in person, if you don't believe that I've delivered, tell me, I'll give you your money back. Absolutely no financial risk to anybody but me.
He means it, folks. I do question about how much of the vetting process is. He did welcome in Steve Enders, so we'll see. Steve's also a good friend and a mentor of mine, so he's going to be speaking at this. He's amazing. All right, Rick Rule, it's good to connect with you once again. We'll see you in a month, and best of luck. Thank you so much.
Trevor, just one more thing, if I may. Any
sure.
of your listeners who want to communicate with me about their natural resource stocks are invited to do so personally. Go to my website, ruleinvestmentmedia.com. List your natural resource stocks. Please no pot stocks. Please no tech stocks. Please no crypto. I'll rank them 1 to 10. No obligation, no charge. And I'll comment on individual issues if I think my comments have some value. Ruleinvestmentmedia.com. List your natural resource stocks.
All right. Thanks, Rick. Have yourself a great weekend.
Trevor, thank you so much for the opportunity. I look forward to hosting you in Boca Raton.